Hello, everyone. Good morning. Welcome to our webinar on taxation of free zone person and UAE corporate tax law. Very brief about us. We are Premier Brains Global. We are a 12-year-old firm that specializes in audit, accounts, tax, and business advisory, and currently located in Dubai as our head office. And locally, we are present in Abu Dhabi, Oman, and Kuwait, and currently in the process of setting up in Saudi. We are also part of an international association called Audit Trust, which has offices in over 100 countries in the world. We are listed with all major banks and are an approved tax agency for many years. And our motto is always doing the right thing. So this is about us. So can we, Vineet, can you please move on to the next slide, please? So very briefly about me, we are going to have two speakers today. The first one is me, and after a while, Vineet will join and he will give his introduction. My introduction is I am a chartered accountant. I've done my CA way back 2003, roughly around 18 years. And I've done my MBA from UK many years back as well. So I'm a listed auditor with Ministry of Economy for many years, and I sign financials here. And my experience include working with Big Four, Ernst& Young, Dubai, Ernst& Young, Deloitte, and a private equity in the past. So that's about me. Can we have next slide, please? All right, so I will be starting the session covering the first part of it. Basically, it's about Cabinet Decision number 55 and Ministerial Decision number 139 of 2003. These are basically the most important, what you call decisions on the free zones issued by the Ministry of Finance or FTA, right? So this talks about qualifying free zone person and then qualifying income and various other combination which are explained in. So if you want to read more about it, please take a look at the standards. Can we have next slide? So let me go a little bit in explaining what is a qualifying free zone person. So this is a very important slide because first we need to assess whether the free zone, which, for example, if you are having an entity in a free zone, the first question which you need to answer is whether your free zone is a qualifying free zone or not. That's a very important question. So what it also means is it's not that automatically every free zone becomes a qualifying free zone person. And now the next question you might have in mind is how will I find it out? So yesterday there was a session by Ministry of Finance in Sharjah on the corporate tax. So what we have come to understand is that you have to approach your free zone to find out if your free zone is listed as a qualifying free zone person or not. Uh, to fall into this category. So a qualifying free zone person is actually the place where you will get the benefit of 0% corporate tax. So that's very important. So it's very, I think, important for you to approach your free zone, ask that question. I know it might not be a ready answer with them at the moment, but that's what it has been informed. So that I think the free zone itself has to go and approach the Ministry of Finance to get them listed for qualifying into this. So what is a qualifying free zone person? So qualifying free zone person is a judicial person incorporated, established or registered in the free zone, which meets all the below conditions. So what are those conditions? The first one is maintains adequate substance. So those of you who have done filing of economic substance regulations in the past, ESR, must have come across this word adequate substance. So what it actually mean is that when you have an entity in a particular place, just having an entity for the purpose of running your business is not good enough. You have to have some kind of resources in that free zone in order to prove the substance of being in that place. So many times I've seen companies opening offices in free zone when all their visas are always in the mainland company or structures like that. So when you want to become a qualifying free zone, it's very important that you have to have a substance there. Substance can be in many forms, like having adequate employees, adequate assets, adequate operating expenditure. These are some of the areas. This is very similar to what was there in the economic substance regulation. So just have this is a very relevant point, because sometimes you are sitting in a qualifying free zone and assuming that you will be 0% corporate tax and file the return accordingly. However, when the audit comes or something happens and you're not able to substantiate the substance itself, it can become a problem. So do pay some attention to that. So that's first point number one. The second one is deriving qualifying income. So what are the different kinds of qualifying income? We have that definition in the next slide, which Vinith is going to cover. So you will come to know what is a qualifying income. So very important, you have to have substance. Secondly, you must be earning a qualifying income. So not every income, only the qualifying income comes to the 0% category. Important, right? Thirdly, the corporate tax law also allows you to either act for 0% corporate tax, or you have a choice to go for 9% corporate tax also. Many companies or entities can choose to go for regular CT rates because of the group structure of many reasons. They can be entities running losses. So if they do not go for regular CT, they can, look at how to structure it. So that's the reason companies might choose. So it's very important that you should not choose for regular CT rate. So regular CT rate is your 9%, right? And the fourth one is complies with transfer pricing rules. So I'm sure by now everybody must have heard of this word transfer pricing. Transfer pricing is nothing but when you transacting with your related parties, the transactions should be at arm's length. In other words, the transaction with your related parties should be as if you would do with any other third party. So that's transfer pricing. So you have to have maintain transfer pricing rules if you are dealing with your related parties, and maintain adequate documentations. So one more thing I wanted to mention, there is another decision that was issued on the transfer pricing documentation, which talks about that if you have turnover of more than 200 million dirhams, then only you have to prepare certain documentation. So let me just give you a little snapshot on that. So that 200 million limit says that you don't have to maintain the local file and the master file for the purpose of filing uh, your corporate tax return. So, but it does not say that if you don't have that turnover, you don't have to follow transfer pricing. So what it means is transfer pricing is still required to be followed, but only if your turnover is above 200 million, then you have to do local file and master file. But if it is less than 200 million, you still have to do transfer pricing, but need not maintain local file and master file. So in very brief. The fifth point is the non-qualifying income should not exceed 5 million or 5% of the total revenue, whichever is lower. So what it means is, like, for example, if you are a free zone person and you are generating a lot of revenue from your qualifying activities, which we will come to know what is a qualifying activity in the next slide. But other than that, you might still have some non-qualifying income, which does not fall into that definition of qualifying activity. So there is a limit prescribed in the law that the non-qualifying revenue should not be more than 5%. For example, if a free zone is generating some revenue from mainland entity, for example, and the customers are in mainland, they're generating. So that might fall into a non-qualifying revenue. So that portion should not go over 5% of your total revenue, or 5 million, whichever is lower, right? So this is also very important, because the moment this is de minimis condition, so the moment you break this condition, you are no more a qualifying free zone person. So you should look at your clients, your customers, your contracts in place, how much, and estimate how much revenue you're expecting to generate from non-qualifying revenues if you are a free zone person. And now whether you are qualifying free zone person is another question. You have to ask your free zone, but still at this stage, it is good that you should estimate how much your non-qualifying revenue is sitting in your P&L or expected to come into your P&L, right? And the last one is maintaining the audited financials is a mandatory requirement. So I know a lot of free zones already are asking for the audited financials to be prepared, but there are some free zone who are not very adamant about getting the audit reports. But once you are a qualifying free zone person, there is no choice, but you have to maintain the audited financials. So I just repeat the points. So maintain adequate substance, derive qualifying income, not elected for regular 9% corporate tax rate, should follow transfer pricing, maintain local and master file if turnover more than 200 million. Non-qualifying revenue should not go over 5% of total revenue or 5 million, whichever is lower, and maintain audited financial statements. So this is what is a qualifying free zone person. Now the rate of tax. So for the qualifying income, the rate of tax is 0%. We know very well. And for the income which is not a qualifying income, then the rate of tax is going to be 9%. So that's it from my side. Vineet, can we move to next slide and can you take over from there? Thank you. Also, sorry, one before I go, one point I forgot to say that once you get disqualified as a qualifying free, you can see in the window right there. If you are disqualified from being a qualifying free zone person in 1 year, then you automatically is disqualified for that year and the subsequent 4 tax period. So think about it, that if you miss 1 year, then you are going to automatically miss next 4 years. So very, very important that you look at your status and the conditions are correctly done. So any kind of miss here, you will miss for a long period of time. Thank you. Vinit, take over, please. Thank you. Vinit, we cannot hear you. You are in mute.
Okay, sorry. Is it fine now?
Good.
Yeah. Okay. So, very warm welcome to each and everyone present here. And it's a very good day for this webinar today. For a simple reason, we also have a seminar by the ministry in the afternoon in the Dubai chambers. So a lot of unanswered question in case people feel may put it out there. And let's see whether these unanswered questions are answered there. Never mind. And to just go forward. Let us touch base upon the definition, or I would say which was a much awaited definition of a qualifying income. And I'm sure people who have joined here are more interested in knowing this, since majority of them we believe would be a part of the free zone entities. So when we look at the qualifying income definition, primarily what we understand is three buckets have been created from the ministry's side. One, two, and three, which you see in the columns there. The first bucket being the transaction by one free zone person with other free zone persons. Second bucket being transaction by a free zone person with a non-free zone person. And third bucket is the any other income which meets the de minimis rule, which Rishi was just explaining as part of the pillar conditions. So let us understand it turn by turn, and we will try to keep it very simple and very basic so that you have answers to the basic questions which may be relevant to your organization. So let us start with the first bucket. The first bucket deals with the transaction by a free zone person with another free zone person. So the transaction here is between two free zone persons. That's the first thing which you should keep in mind. So majority of the transactions from by a free zone person with another free zone person becomes a qualifying income unless that activity is an excluded activity. So we have a list of an excluded activity. We call it a negative list, or we can just simply say a list of activities, which we have listed down for the sake of understanding. So let us see which are the excluded activities here. Let's start with first. These are the transaction with natural persons, subject to few exceptions, and exceptions are for shipping, aircraft, fund, wealth management, or investment management activities. So unless and until we are dealing with a natural person for these activities, any other transaction by a free zone person with natural person would be an excluded activity. So in short, I would say if you're dealing with natural persons, please ensure whether this negative list is attracted or not. The second would be any activity related to banking and insurance, except for some reinsurance activities. Third excluded activity is dealing with financing and leasing activity. Of course, again, we have an exception over here, and it is a very welcome exception considering the situation and the business environment in UAE. Those exceptions are the treasury and financing function to a related party, or it is related to aircraft and some related components. So primarily, any function, any finance and leasing activities are excluded activity. However, if these activities are with your related parties or in relation to an aircraft and the related components, those are not excluded activities. So it is an exception within an exception. You should read it that way. We go further, we see some immovable property related exceptions. So as you read it, ownership or exploitation of immovable property, except where the commercial property is located within the free zone and transaction is also with the free zone. We will deal with the immovable property aspect separately in the next slide. However, for the sake of understanding, just look at it as a immovable property exception. And last is anything which is related to the ownership or exploitation of intellectual property assets. So when the transaction is by a free zone person with another free zone person, it is allowed and it would be a qualifying income, except where it is related to any excluded list activities. So in your business circumstances, you should segregate the transactions within the first bucket into two parts. First is transaction which attracts the excluded list and other transactions. So excluded list, you should keep it out, and the any other transaction other than the excluded activities is something which would be a qualifying income. But interesting to note, they have kept the additional condition over here, which you see or which you read as an beneficial recipient test. So this is nothing but in a very technical terms called as anti-avoidance rules, which basically states if you are selling a goods, just taking an example of a sale transaction of goods in a trading organization, if you're selling a goods to another free zone person, so that free zone person should be the beneficial recipient of those goods. In other words, I would say that free zone person should not be a conduit entity or just a middle entity or a pass-through entity where the ultimate beneficiary of the goods is a mainland entity or I would say more specifically a non-free zone person. So that's where the anti-avoidance rules come in play. So a bit of documentation would also be required, even though the transactions are with other free zone persons. So that was the first bucket. Now let us discuss the second bucket. And second bucket again is related to the transaction by a free zone. But here your opponent, or I would say the transacting party would be a non-free zone person. Uh, to be very specific, at the outset, non-free zone person can be a mainland entity as well as the foreign entities. So in case you have any exports of goods or services to anyone outside UAE, of course, that does mean an export. So that would also be a transaction with a non-free zone person. So it could be a mainland entity, it could be a foreign enterprise. However, these transactions have to be in relation to the qualifying activities, which are again not the excluded activities. Excluded activity we just saw discussed a few minutes ago. But what are qualifying activities is something which we'll see in the next slide. And I will directly jump to the excluded activities and come back over here to discuss the de minimis rule. So let us understand which are the qualifying activities, or I would say a permitted activity when you're dealing with a non-free zone person. So we have tried to, or we have attempted to categorize it as per the sector or as per the business model. So first is the shipping industry. So in case the transaction is in relation to the shipping, which is ownership, management, and operations, those would be your qualifying activities. To put it very simple to understand, a free zone person is dealing with a non-free zone person, but that free zone person is dealing or in the shipping industry, either owning and managing the ship or operating the ship. So that's how it should be read. Second category is for the manufacturing activities. So in case a free zone person is undertaking any manufacturing function in the free zone, which includes the processing of the goods, then that activity also qualifies to be a qualifying activity. A question may come up, okay, how the manufacturing activity should be viewed, whether contract manufacturing would be allowed, etc., etc. Those questions will definitely come up, but partly those questions are answered by way of maintaining the adequate substance. In our view, contract manufacturing, even though a principal manufacturer is outsourcing the manufacturing activity, should be okay as long as the contract manufacturer or the activity of the manufacturing is undertaken within a free zone. To put it differently, if the contract manufacturer is located in the mainland, then there would be a problem from an economic substance standpoint, and the benefit may not be available. So in case you have any business setup which is dealing in the manufacturing industry, so you may look around all these aspects. Distribution, I'll touch it later before after the service discussion. I'll directly jump on to the holding of shares and securities. So in case a free zone person is holding any shares or securities and deriving some income out of it, it appears to be a qualifying activity. But the way the law has been worded, it says holding of shares and securities. Definitely that the two stream of incomes which may come from holding of shares or security would be dividends or capital gains. It would be welcome from the ministry if they clarify whether they want to include the capital gains or not. But prima facie, it seems it should be allowed. However, the second question does come up: what does securities mean? Because securities have not been specifically defined under the UAE corporate tax law, so we may rely to the definition which is there in the other commercial law. So that should be the case to see it. But never mind, if you are not within the qualifying activity, you may evaluate the participatory exemption conditions. Of course, that doesn't come free of cost. You again have to satisfy many conditions to avail those benefits. However, just keeping it very high level today, holding of shares and securities do qualify as a qualifying activity. Then let us discuss the services, and I think this could be a major concern areas for the entities which are into the service sector and providing certain services like marketing or brand promotion or simply doing some designing, web designing work, etc., etc. So there are only few listed services, or I would say a positive list of services which are permitted to be a qualifying activity. So let us discuss it one by one. First is any reinsurance services. Second, fund management services. Third, wealth and investment management services. Fourth, interesting and a very welcome step, headquarter services to a related party. Next, treasury and financing services to related parties. So this is also a welcome step. And second last being financing and leasing of aircrafts and the components, which are engines and rotable components. And last, the logistic services. So apart from these listed services, if you are having any other services, probably it would not be a qualifying activity and you may not be able to take the advantage of a qualifying income or 0% on a qualifying income. So depending upon the business model, you may evaluate whether you're falling in the positive list or not. If not, definitely 0% would not be available. So that's what the services are concerned. And now let us discuss the distribution. And I think the major concern area or the major interest area would be the distribution side. So let us see how it is worded. Simply stated, distribution activities do qualify as a qualifying activity, but again, it doesn't come free of cost. We have three pillar conditions for a distribution activity to be a qualifying activity. The first condition says the activity must be undertaken in or from a designated zone. So very interestingly, the concept of designated zone, which we see in the VAT laws, has also a footing when it comes to the free zone qualifying income category. So your activity of distribution should be conducted in or from a designated zone. We already have a list of designated zone, which is again linked to the VAT. So in case your free zone activity or the distribution activity is done in or from the designated zone or any of the designated zone should be the case as a first condition. Second, the transaction is expected to be a B2B, that is business to business. Basically, it should not be to an end customer which uses it for its own consumption. It should be either for a sale or resale or for the manufacturing processes. So that's how the second condition of B2B comes in play. And a third condition, and I think the more attention should be paid here, the way it is written. It says the goods or material entering the state, that is UAE, must be imported through the designated zone. Again, the condition or the words designated zone comes in play, which is again linked to the VAT laws. So the interesting part is the word must be imported through the designated zone. So in case you're having an imports, your imports have to be routed through the designated zones. So that's the third condition when it comes to the distribution. So your distribution activities satisfying all the three conditions together would be a qualifying activity, and in turn, any income is arising out of it would be a qualifying income. So that's how the qualifying activities have been listed or defined under the law. And one more point to add over here, in case you have any auxiliary activity which are related to this pillar activities, those activities would also qualify as a qualifying activity. Ancillary activity, to understand it in a very simple terms, are nothing but linked to the main activity of shipping, manufacturing, distribution services, or holding of shares and securities. Basically, it should not be an independent activity. And in case the answer is yes, if it's an independent activity, identifiable activity, then definitely we should see the primary condition first. It may not qualify as an ancillary activity. So this is how the qualifying activities have been defined. And depending upon the business case or the business model which you have or the transactions which you have, you should be putting the transaction in any of these categories and then looking whether a benefit would be available or not. So let me go back to the main slide. So we discussed the bucket one, which is free zone to free zone transactions, except for the excluded activity. The second bucket, free zone to non-free zone transactions, but only in relation to the qualifying activity, not being the excluded activity. And last bucket, which is dealing with the de minimis rule. Interestingly, the law, I would say, is fair enough over here, but because for a simple reason, assume you are doing a qualifying activity, but as a part of the business, you may also have some revenues from excluded activities or a non-qualifying activity when you're dealing with a free zone person. The law recognizes the fact they don't want to penalize the business and businesses just because they have only a fraction of excluded activities or non-qualifying activity. So to overcome this hardship, the de minimis rule comes in play. However, the de minimis rule again should have, and it is having a threshold, which is nothing but the non-qualifying revenues should be lower of 5% of the total revenue or 85 million, whichever is less. So that's the logic behind bringing the de minimis rules in picture. So in case you have any other income which are not your excluded activities or not a qualifying activity, you may have so, but again, it should be only a fraction, which is nothing but 5% of your total revenue or 85 million. So that's how we sum up the bucket one, bucket two, and bucket three. We understand there would be a lot of questions. So at least we have tried to bring up some case studies which may have some answers to the questions. And we also have a Q&A session where you can put forward the question. Moving further, let us discuss which are the incomes which are not a qualifying income. So I purposely used the word not a qualifying income. That word should not be used. The correct words are income other than qualifying income. So be mindful of the fact the law doesn't define non-qualifying income. They only define non-qualifying revenues. And if you see the definition of non-qualifying revenues, these are the revenues from excluded activities and non-qualifying activities with non-free zone persons, wherein the de minimis rule should be checked. Again, coming over here, the correct words are income other than qualifying income. So these are special categories of income. First of all, these categories of income attract straight away 9% of the corporate tax rate. And these incomes are not to be considered for calculation of the de minimis rule. So I would like to start it from that angle. And now let us look at it. Which are these categories of incomes? So two broad categories. One, Article 5 of the relevant decision, which deals with the permanent establishment incomes. It can be either a domestic permanent establishment or a foreign permanent establishment of the qualifying free zone person. Just assume a domestic permanent establishment to be a branch of the qualifying free zone in the mainland. If it's a branch, it is deemed PE in majority of the cases. So in case you have any transactions with a domestic branch of the qualifying free zone person, that is permitted. but whatever income would be attributed to the branch, it would attract simply 9% corporate tax rate. But that income should not be clubbed while calculating the de minimis rule. And similarly, we have the section for a foreign permanent establishment. These are branches which are outside UAE. Of course, we have another provisions in the law which talks about the exemption or a foreign branch or foreign PE exemption. So these provisions may be read along with those conditions, and depending upon the business cases, you may evaluate what would be the tax implications in these circumstances. So that's how article number 5 has been defined. It is a bit technical. Considering the time constraint, we are not getting into the nitty-gritties of it. However, let's see how the immovable property is attracting the taxation. Before moving to the aspects of free zone person related to immovable property, let us first take an example what constitutes an immovable property. The word immovable property has not been defined under the free zone relevant decision, but it has been defined in the Cabinet Decision 56 of 23, which reads as it is any area of land over which rights or interests or services can be created, or any building structure or any engineering work attached to the land permanently or attached to the seabed, or any fixtures and equipment which makes up the permanent part of the land or permanently attached to any building structure or engineering works of the seabed. So to understand simply land, of course, we understand we cannot move a land because it is stationed there. It is part of the earth, Mother Earth. But now if I have a building, then there has to be a condition of permanent attachment to it. A temporary structure, for example, a huge machinery which can be, dismantled and taken over may not qualify as immovable property. But something like a warehouse, which is permanently attached there, there are the civil works which are attaching to the land, etc. Those are the immovable properties. So something which cannot be moved to be very simple as far as the definition is concerned. And then we see the definition of a commercial property. Commercial properties are something which is defined in the relevant decision of the free zone, which says these are immovable properties used exclusively for business or business activity, but not used as a place of residence or accommodation, including hotels, motels, bed and breakfast establishments, service apartments, and the like. So imagine a case you have an immovable property, but that property can be used as a place of dwelling, which is a residence or any kind of accommodation. Then that will not qualify as a commercial activity. So to put it simply, that will be a non-commercial activity. Simple examples are your residential complexes, staff labor accommodations, hotels, etc., which are there in any of the free zones, etc. So these are all would be a non-commercial activity. A reality check, if you do, hotel industry do not have then the benefit of 0%. By default, they then go into 9% category. Never mind, if you have a warehouse in a free zone, of course, warehouse cannot be used as a place of residence or accommodation. Then yes, definitely, if you're leasing any warehouse in the free zone, it becomes a commercial property. With this understanding, now let us understand the implications when it comes to the free zone benefit. So Article 6 categorically has a sub two categories. One is for commercial property. So when it is a commercial property located within the free zone and transaction is with a non-free zone person, it attracts 9%. To put it very simple, if the transaction is with a free zone person and it is a commercial property located within the free zone, then of course 9% is not there. It could be 0%. And when it relates to a non-commercial property, it has to be located within the free zone and transaction can be with any person, be it a free zone or non-free zone or any individual. So those attract straight away 9%. So that's how this special category of 9% has been defined and has been guided in the relevant decision. And I stated income other than qualifying income. It should not be read as a non-qualifying income. So that's how the theory comes to the end. And before we get into the case studies, I would have some polling questions here. So can we have the first polling question, please? Okay, so whether the designated imports and local sales by a free zone person qualify for qualifying free zone benefit. So you may answer it. the way you understand the law. So these are the imports from a DZ, and that there is a local sale to a mainland by a free zone person, whether it would be a distribution activity. I have submitted my answer. Others may submit it soon. We may wait for 15 more seconds. Okay, so we have some 12 responses. Okay, responses are still coming in. We wait for more 5 seconds. Okay, so at least the responses which have come in, majority, like 50% or 56% of the crowd feels it should be a qualifying activity, and there are 46% saying no, with 0% of the crowd wanting the clarification towards this. Okay, so yeah, definitely we too believe if their imports are from a designated zone and there would be a local sale, to put it under the bucket, it may fall under the bucket number two. Of course, we need to see other conditions as well, but assumingly other conditions are met, the answer could be yes. Can we have the next poll, please? Okay, the interesting question comes up. DMCC, RAC ICC, which are not the designated zone, whether they qualify as a free zone for corporate tax purposes. You must submit the answers as per your understanding, and then we can discuss what could be the way out. So I submit my answer. Let's wait for some more answers. We wait for 15 more seconds. Okay, we have been receiving the responses. 5 more seconds, and then we discuss. Okay, so let us discuss. We have somewhat mixed opinion from the crowd. I think 32% says yes. The number is increasing. It is 34, but 41% says no. And few 24% of the crowd wanting the clarification towards it. Okay, so let me answer this question. Basically, when you read the definition of a free zone, it says there would be a relevant decision out listing the free zone as a free zone for corporate tax purposes. So I think the answer could be more towards the clarification would be awaited because the law simply says it. But when it comes to a designated zone, what we believe is they would be the free zone for the corporate tax purposes for a simple reason. The designated zone has been mentioned as the criteria for a distribution activity. But of course, the free zones which are not a designated zone, definitely we believe some clarification or decision should be coming out in coming days. Let us see whether this question is being answered in the today's seminar by the ministry. If we have the answer, it would be a great answer. Let us have the third poll, please. Okay, so again, an interesting question, and I think the crowd would be willing to answer this. Whether high C sales would be considered as distribution activity for a qualifying free zone benefit. So I submit my answer. I would request everyone else to submit as well. And then we wait for 15 more seconds. Okay, we wait for more 5 seconds, please. Okay, that's it. So again, we have a mix of the opinion, but many, or I would say more than 50% or near to 60% of the crowd feels high C sales would be taxable activity. 20% of the crowds would want the clarification from the ministry, and the balance are saying yes, high C sales will be covered. Okay, so I will not answer this question because it becomes a quite tricky one to have an opinion currently. But yeah, the way law has been way worded, it seems the intention would be to tax the high ski sales for a simple reason. The designated zone words are coming in as far as distribution activities are concerned. Had the intention not to be taxing the high ski sales, probably the opinion may change. However, we are not concluding it. We may wait for the clarification, and we may have another view. High ski sales may be tax free or qualifying activity. but just to put the discussion to end currently, we may wait for further clarification. If the clarification is not there in the coming days, then we may take a call depending upon the business case and the way law can be interpreted. Yeah. So that brings me to the end of the polling session, and let's move on to our first case study. And we have deliberately kept two case studies here. And let me also see whether we are running out of this time. Okay, so it's 11:42. We have 20 more minutes. So let us quickly take it up. Two case study in the interval of 10 minutes. First case study deals with the logistic activity. So we put the facts in front of you. There is a free zone entity called AFZE, which is registered in Jafza, being a designated zone, and which is into logistics service provider providing activity. It has contracts with mainland entities and free zone entities. It also owns a warehouse which is leased to another free zone company called BFZE. A company has given interest-bearing loans to related parties as well as non-related parties who are not a free zone persons. A company also has a technology transfer agreement to provide a use of tracking system to a mainland and free zone entities. And it also owns a staff accommodation, which is partly leased to again BFZE. And let us assume all the other conditions are satisfied when it comes to the qualifying free zone benefit conditions. When we see the numbers, again, please do not audit us on the numbers. We have deliberately kept the number in such a way that we can correlate it with the de minimis calculation. So let us see. If you see the P&L, and these are only the revenue numbers, we have again not touched basing upon the cost aspect because the words are qualifying income. It is another word mean the income minus the expenses. But for the sake of discussion purposes, let us only discuss at the top line level. So when it comes to the service income, we have income 250 from free zone entities and the non-free zone entities. These are your logistic service providing incomes. When it comes to interest incomes, one from related parties and non-related parties. We have royalties coming in, again from a free zone person and a non-free zone entities, 5 and 10 respectively. And the rental incomes coming from the warehouse, 5, and staff accommodation, 0.5. So that makes my total revenue as 522.5. So to analyze which would be my qualifying income and non-qualifying income, the way we discuss, we should be starting to put the transaction in the three buckets and the fourth bucket of income other than qualifying income. So let us see turn by turn how we can bucket it together. So any income first we see should be a free zone to free zone, not being an excluded activity. So services income from a free zone person, of course, can be qualifying income. And let's check whether it is in the negative list or excluded activity list. The answer is no. So yes, this could be a qualifying income. So I tick it mark. Next, the royalties coming from the free zone entities, whether it should be a qualifying income. The first condition, free zone to free zone, yes. But if you see the excluded activity, these are attracted to the ownership and exploitation of intellectual property rights. So it becomes a excluded activity. So it should not be in bucket one. Then let's see the rental income from warehouse. Okay, whether it's a commercial activity, I would say yes. The transaction is also with the free zone entity, which is BFZE, and the warehouse is located in the free zone. So yeah, it could be a qualifying income and excluded activity list is not attracted for a simple reason. The transaction is with a free zone person and it's a commercial property. But interestingly, I put staff accommodation. Now, let me take you back to the definition of the commercial activity, which says used for business purposes, but not used for accommodation. Now, staff accommodation, definitely it is used as a dwelling place. So it has to be categorically carved out and put in the 9% categorically directly. So this should go in bucket number 4. So bucket number 1 would be 250 and 5. Okay, so let us, and bucket number 4 is 0.5. Let us discuss bucket number 3, which is the transaction with the non-free zone person. So 250 coming from the logistics activity, whether it's a qualifying activity, logistics service providers are included there. So yes, this becomes a qualifying income under bucket number two. Interest on loans to non-free zone persons, related and non-related. Okay, let us see whether related. Yes, we see a specific mention in the qualifying activity list. Non-related parties are not there. So with the income which is coming from the loan to a related party qualifies for bucket number two. One does not qualify, so it goes into bucket number three. And royalty we already discussed, and staff accommodation and warehouse we already discussed. So now let us see the solution, what comes out. So in bucket number one, I see 250, which is my logistic service income from free zone entity, and the rental income, which is coming from a warehouse, which is a commercial property. So that fills my first bucket. Second bucket, the logistic incomes coming from a non-free zone person and the interest on loan coming from a related party. So that fulfills my second bucket. Third bucket, we first see the de minimis rule. So I directly go to the calculation first. And first, let us discuss bucket number four, which is now simple. The staff accommodation, which will be qualifying as non-commercial activity. So straight away 9%. So it sits in 9% domain. And then we see the de minimis calculation. And interestingly, the way the formula is, first we need to derive the total revenues, which would be the total here, excluding this zero point 0.5, because if you recollect my discussion, again, going back, income other than qualifying income are not to be considered for de minimis rule. So that's how I exclude it over here and arrive at the total revenue for de minimis calculation. And then I look at the non-qualifying revenues being royalties and interest from non-related party, which turns out to be 16. And when I divide 16 with 522, it becomes 3%. So my de minimis calculation is also met, and that's how my third bucket is also fulfilled. So my royalty incomes and interest on loans to non-related parties also become my qualifying income. For the sake of discussion, we have kept it very simple, and of course it is a webinar. We cannot have one-to-one discussion, but definitely in Q&A session we can have it. But we try to touch base on how the practical scenario would be looking like. So if we see the total taxable revenue, two categories, 0%, which makes it 522, which is here or which is here, total of this, and then 5,000 or 0.5, which is my fourth bucket, which will come over here. So that's how we sum it up our first case study. And before moving to case study two, we have 10 more minutes and we see some participation, active participation as well. So let us discuss the second case study, which is dealing with the clearance of the goods to a mainland branch by a qualifying free zone person. We will go a bit faster over here. Company A is a free zone entity registered again in Javza, which is a designated zone, which is importing the goods for onward sale. And it also has a branch in mainland, which is dealing in a wholesale operations. So when it comes to facts of the case, if we see the imports, there are two categories of import by company A. 2 lakh dirhams coming from a D zone, which is imports through D zone, and 10,000 which are imports to a non-designated zone. Primarily, you can assume it coming in from some Oman or by way of a road route. Then we have sales. We are selling it to the mainland branch or clearing it to a mainland branch. And these are from the DZ imports. So out of this 2 lakhs purchases, 150 of sales value is cleared to the mainland branch. 12,000 are again cleared to the mainland branch, which is coming from non-DZ purchases. And then we have exports from the designated zone purchases and sale to other free zone person, the balance shipments again coming in through the imports from DZ. So this is how my sales are looking. And also I have some other income from providing the back office support services to group entities on Oman and Qatar. The income is very minimal, which is 5,000. And this is how my branch accounts will look like. The purchases, which is a sale from a qualifying zone, which becomes purchases from a branch. So 150 and 12,000 would sit as a purchase cost from a branch. And then I will have an ultimate sale of 2 lakhs. So this is how the facts goes. And now quickly see how the buckets would be there. So the transaction with free zone entities not been excluded activity, which are my sale to other free zone person, which is nothing but the 1 lakh dirham, which is sitting here. Bucket number two, sale to mainland branch, which could be permitted, and the exports. But again, when it is a sale to mainland branch, only the DZ purchases and export, which are again from DZ, would sit in bucket number two. So my 150 and the 1 lakh will sit in bucket number two. And then we see the de minimis calculation. Of course, if you see the third condition, if you are imports, imports have to be through a designated zone. So any imports and sale from a non-designated zone purchases will be a non-qualifying revenue. And of course, back office support services is also a not qualifying activity. So it has to be tested from a de minimis rule. So which is sitting over here. And let us see the branch income, that is bucket number four. Again, my point would relate back to the domestic permanent establishment. So this is the case of a domestic permanent establishment. So 200 is sitting over here, which will attract directly the 9%. So 9% would be on the 2 lakh and not on the sale value which a qualifying person is doing to the branch. So here we need to see the branch PNL, and whatever sale is attracted at the branch level will be subject to the 9%. Considering the time constraint, we will move forward very quickly, and we take up the Q&A after Rishi completes his part. So Rishi, I hand it over to you. We would be forwarding this slides to you. You can reach to us one-on-one if you have more queries. And Rishi, up to you now for the way forward.
Thank you, Vinit. Thank you for taking through the session and clarifying a lot of important areas in the free zone. So can you move to the next one? So basically, this slide is about how you as a company prepare for the corporate tax. So there are a lot of things which needs to be done in this process. One of the things which I would start uh, s- uh, uh, to say here is that do not just register in a rush, because nowadays I can see a lot of emails are floating. People are sending messages and all that saying that register for corporate tax. This is a deadline and all that. So my humble request is do not rush it. Take it easy. There is no such deadline of like say 30th June or 31st July has been there that you have to register unless your financial year starting from 1st of June. That's a different matter. But if you are following a calendar year like January to December, so your first financial year for tax purposes will start from 1st of January 24 onwards. So you don't have to register now or like tomorrow to be there for the corporate tax purpose. So very important that the registration is the first step into the arena of corporate tax. So do it carefully, have enough research done, whether you are a qualifying person, not a qualifying person, whether you want to go for small scale, business scale, because there are a lot of other different topics on the corporate tax, which we are not covering today. So, but it's my humble request to be careful when you're registering, because once you register, amending that or changing that, it's a very long, lengthy, and costly process, right? So how do we do basically corporate tax, what you call understanding or registration? So how we as Premier Brains are working is we are dividing that in two phases. Phase number one, which we try to do the first step, which is basically the impact assessment. So what we do in impact assessment is basically understand your business a little bit, the kind of business transactions your company is doing, and then see whether you actually fit into the definition of a qualifying free zone person or you're a mainland person. So that is very carefully and clearly be defined. Then you have to look at whether you follow into a particular small scale business. Do you want to go that route or not? And like if you have a lot of group companies, so if a company is making tax losses, another is a taxable profit, so do you look at making a tax group, or you just group it without forming a tax group? Because there are a lot of different possibilities available in the corporate tax. In a way, there are a lot many clarifications out there, but uh, there is things which you need to understand before you take a decision on the registration. Very, very important. So that's what we do. Secondly, it's very important to understand aspects like your allowable expenses. So one of the normal tendency of a lot of companies is, I mean, as a layman, anybody will do it, is that when you have good profit, the first thing you want to increase the expenses by charging high management fees or shareholders basically salary at a higher price and all those kind of areas. So you have to be aware of the fact that we have very strong transfer pricing rules in UAE. So the 200 million limit, which is announced by a cabinet decision, is about maintaining local and master file only, but it's not saying that you don't have to do transfer pricing. Transfer pricing is still applicable. So management fees. So when we look at transfer pricing, there is a definition of connected person. So all the shareholder, key stakeholder, including your say CFO or all the top guys, are actually also the key stakeholders. So when we say related parties, and it's also connected person, so you need to be aware that what are those parties and what can you charge. So be careful putting expenses, whether those are allowed or not needs to be understood properly. So that's what it is, tax disallowance. So it's very important. You need to assess what is allowed, what is not allowed. Excuse me. And then we have certain areas of exempt income like dividend income. Domestic dividend income is exempt, but outside income can be taxable unless it satisfy the participatory exemption conditions. That has to be seen. Then you have to also see view, like for example, getting money from overseas where there is withholding tax. Like if you, for example, getting money from Saudi and there is a withholding tax there, and you're not able to refund it there, but you can think of claiming as a tax credit against your um, taxable amount. So these are the areas you need to assess. That's what happens in that impact assessment. And the more thing, and then once we do the assessment, we understand whether you want to form a group or not form a group, what are the different angles to registering, and which is the right business model for you to go forward. Very important in the impact assessment, because we have already discussed that if you disqualify yourself from being a free zone person, qualified free zone person, you close the window for next 4 years. So it's a very important condition. Do it carefully, being the first corporate tax year for you. Be careful on what you take the decision, because that's going to shape your entire story in the corporate tax going forward. So then, as I've already covered the planning part, and the third one is transfer pricing. I think I've already also talked about it. One thing I want to add to it is that on the last day of your financial year, which financial year, or the first day of your tax period, you have to ensure that your balance sheet is at arm's length. So you have to look at all the related party balances which are sitting at the end of the year, before on the first year of your corporate tax year, to be fair valued and benchmarked properly. That is very, very important, because just putting like for example, if you have a lot of related party transactions sitting in the balance sheet, balances sitting in the balance sheet, you should think about clearing a lot of it and keep it simple and straight. These are some of the important things to look. So I think we are just take another 5 minutes. I thought it's important to actually explain what it is in the way forward. So please bear with us for another 5 minutes. And so that's phase one. So what we do is we help in doing the impact assessment planning and advise you how our transfer pricing works, and then help you then register in a proper way for the corporate tax. And then the phase two is basically once you're registered, then following all the tax returns, filing documentation, all that we take care of. And being a tax agent, we have been doing this in VAT, excise, and the other compliances for a long time. So that's it from me, Vinit. I think let's look at the questions and then wrap it
Yeah.
up.